I want to turn around and talk about the markets at this point. I mean, who hasn't seen the huge increases that we're flirting with these all-time highs? Our individual stocks are skyrocketing. I was looking, actually, even the Russell 2000 has kind of made a nice little quiet move. Everything's quiet, I guess, compared to NVIDIA. But the point is, there's things you should do within that. So I asked Neil McIver to join me, McIver Capital Management. Neil's been in the business for a huge number of years, a successful portfolio manager. He has his own model portfolio that's done extremely well. Neil, let me just start with that. You know, you get a move like this in stocks, it really requires us not to fall asleep, but to pay attention. I mean, maybe I'm overexposed in some areas now.
Well, this is common, Michael. I mean, absolutely dead common. And people often leave portfolios that have outperformed in one area or another, with that outperformance inside of the portfolio. So something you might have wanted to, that should be 20% of your portfolio, was now 40% of your portfolio. Yeah. And one of the great mistakes is just simply to leave it. But you've actually unbalanced your portfolio tremendously by doing that, because you're probably taking too much risk, and you're probably in an asset class that's going to normalize again and move back. But Michael, it all starts with having a strategic asset allocation in the very first place, and portfolio management is really a process. And individuals often lament that institutions do far better than individuals do, and they think that this is an informational thing, and it's not. It's really just about discipline. And the first thing starts off with is creating a strategic asset allocation. And you can go online. There's various resources there. You can look at portfolio strategic asset allocation, portfolio optimizer. And there's those. You can go to our website, McIverCapitalManagement.com, talk to our people on there. My team can help you out by creating one. But what is one? Well, really, a strategic asset allocation is the blueprint for your portfolio. It's a strategic asset mix of various asset classes and market sectors that match what your particular risk tolerance is. And it's going to tell you, what percentage of, say, U.S. large cap growth stocks you should have in your portfolio. That's a obviously popular one right now. Or U.S. mid cap value. You mentioned the Russell 2000, Canadian equities, bonds, high yield positions, how much cash, all of those different things. And these strategic asset allocations have all been back tested, and they're so accurate they can actually project forward what your overall return should be. All institutions use these models when they build portfolios. They know exactly how much risk they're taking in the first place. Now, the key is that you got to stick to that strategic asset allocation. And this is what we were just talking about with part of your portfolio going off the rails a little bit. So, and it might be off the rails in a positive way. It might have gone up very, very nicely, or it may have fallen. But at regular intervals, and most of the studies suggest about once a year, a portfolio needs to be rebalanced back to its strategic asset mix. So imagine that, part of your portfolio, let's say the S&P 500 large cap growth sector, the one that's very popular right now, its long-term normalized rate of return is about 10%. And then let's say it gives you 20% a year for 3 years. Okay, so its normalized rate of return is just 10. It's giving you 20 for 3 years in a row. That extra 30% is going to leave you. It's going to go out the window at some point in time. That's just a guarantee. Look back at 2022. We had a couple of great years, and then the market all came down significantly. And this normalization, it's a natural movement in the market. Everything that outperforms at some point in time gives back those excess returns, and everything that underperforms for a period of time will make up those returns. So it's a process of using that to your advantage. And the rebalance is critical because it takes advantage of this normalization by selling the portions of the portfolio that have outperformed and then buying the parts that have underperformed inside of a portfolio.
Neil, what I like about that is that we're always talking about risk management, as you are as a professional. So you give them a blueprint to be a risk manager that takes sort of the momentary decision out. You already, as you said, worked with your professional. You know where you should be. But the thing that I think is a little easier about this now is we've just seen all of this in action. I mean, it's totally validated historically, but you don't have to have much of a memory other than the last couple of years, as you alluded to. Something that went up, oh, wow, they went down, but stuff that went down, oh, they went up. So this is what protects you in those kind of a market environment. So I just think, that's something that people can wrap their heads around and with real life experience. But I also, just while I think of it, I want to make sure people understand that you've got a webinar coming up on Tuesday, March 12th, right? It's 11 a.m. Pacific Daylight Time, but you're going to be talking about this kind of thing. I mean, what Bay Street and Wall Street really don't encourage you to know. And that's why you need a professional. But let me throw a couple of other things out there at you, because I know you've written some things on this. And it seems like you were prescient at the time, but boy, has that ever been validated, as you had a lot of questions about the ESG agenda we're not talking about the philosophy or climate or anything like that. We're talking about as an investment driver. And I want you to elaborate a little bit more, because as I say, what you've been saying in the past has certainly been validated.
Well, absolutely. I've been talking about it for a number of years. And let me tell you a story. This happened about 4 or 5 years ago. And a somewhat younger but very experienced investment advisor took me for coffee to tell me about this big marketing push that he was going to be doing and how he was going to grow his business. And, sort of as an elder statesman in the business, I'm always happy to help if I can provide a little bit of experience there. And what he told me is that he was going to become an all ESG, or equity, social, and governance advisor. And he was going to become an expert in this particular field and only invest in whatever he considered to be ESG. Now, there's lots of different filters. That's a different issue that we could talk about for a long time. But he wanted to know what my thoughts on this, and I'm sure he wanted to be validated in terms of the direction that he was going to go. However, I have a tendency to be, fairly brutally honest, and I told him I thought it was a terrible idea. I said right up front, you're not going to get my money, because you're telling me, the potential client in this made-up environment, that you have an agenda with my money. And I wish an advisor who is unashamedly an advocate for my future wealth and prosperity. I don't wish an advisor to use my capital for their agenda, regardless of the altruistic goals of that agenda. And I said, I think you're wrong. But there's also another issue that is very, very prescient and important here, and that's positive correlation. So when you build a portfolio, this is very dangerous, and you use these ESG filters, the net result of selecting stocks is that through these filters is there's going to be a relatively high degree of commonality with all of those individual positions. So they're going to be positively correlated, meaning they're going to go up or down based upon the same economic input, which actually you do not ever wish, because that lowers the long-term rate of return and increases the volatility inside of the portfolio. Well, he didn't listen to me. So a couple of years later, we roll into 2022. High interest rates rise dramatically. They murder high speculation and high tech stock. Basically where most of these ESG stocks are the ones that come through these filters live. And most of these stocks fell by 50%, some of them as high as much as 70%. Look at Kathy Wood's ARK ETF. It lost some 70%. Well, unfortunately for this gentleman, he's no longer in the investment business, because his clients also lost 70% of their investments. So, I just encourage folks that you've got a choice in this. You can choose how your money is invested, but you've got to do some research and ask some questions. I think that's absolutely critical.
I wish you had added there, Neil, I wish you had added and listened to Money Talks. Just kidding.
Yes.
But your point is very well taken, Neil, that, it doesn't take a lot, but be interested and ask those questions. Don't be intimidated. But what I'm hearing from you is you got to drive your own investment bus, if you know what I mean, with expertise, with people saying, here's a roadmap, here's a destination, et cetera, but be engaged in that way, because that point is very well taken. We now have, as you said, you've been saying that for about 5-6 years. But we've got quantification of that past your individual anecdotal experience. We see that abandoned. But the bigger point being, there should be one agenda with your money, and that is, how are you doing? Risk management, rewards. That's what counts, not what your advisor or your mutual fund manager's got as a goal, if you know what I mean. The goal should be you.
The goal should be you. And I call it virtue investing. And you might feel good about your investing, but it's not necessarily moving you towards what your final goal is. Now, something I wanted to bring up was an organization called Climate Action 100 Plus. And this is an organization that's got both asset managers, people like me, but much larger than we are, and issuers, meaning corporations out there. And the goal of this group is to force companies effectively to decarbonize, which is in effect to deindustrialize much of the West. And that is the actual stated goal of Climate Action 100 Plus. So it's designed to basically leverage the power of the investors, people like BlackRock that jumped into this a few years ago, and these huge investors, to force corporate action change at these corporations. Companies, by the way, like Exxon, companies like Suncor, and they're supposed to be effectively accepting what these investment managers are saying. Now, just to fast forward to today, there's been a big ESG exit over the last little while. So there's been some common sense that has been infused or has expressed itself in this space. And giant BlackRock recently pulled out of this Climate Action 100 group, this dangerous group, with CEO Larry Fink stating that he doesn't even want to use the word ESG anymore, and that he was, I think, ashamed or embarrassed. I don't remember what the term was. That was followed by J.P. Morgan. That was followed by bond giant PIMCO. That was followed by Invesco and State Street. Berkshire Hathaway had some comments on that. So did Vanguard as well too. They weren't part of it, but they did encourage, and they were on the side of these companies leaving. And this is all because of the citing this basic disconnect and legal problems related to their fiduciary relationship to the client, meaning that they don't wish to get sued for not always doing the best thing for their client because they have this alternative agenda with the capital. But you know, folks, you've got to vote, and you don't have to be trapped by virtue investing. You can do what you wish with your money. But let's have a quick look here at who's still left in Climate Action 100 Plus. Now, remember, the big guys have all left. Literally eye-watering billions of dollars have left this whole area. But who's still in there? BMO Global Asset Managers, Desjardins Global Asset Managers, Fidelity Investments Canada, IG Wealth Investment, Mackenzie Investments, Manulife, NEI Investments, RBC Global Asset Management, TD Asset Management, University of Toronto Asset Management. Well, that's not really a surprise.